number 19. So welcome along, Paul, and thanks, Linda. Do you want to just start by sort of running through what it is and what you're needing from us today, and then we can take questions and go from there?
Yep, no, look, very happy to do that. Thank you, Sam. So look, I'll take the paper as read, and obviously there's an attached paper from EQI Global who have provided independent advice on this matter as well, so I'll take that as read as well. But just a couple of the key points to highlight. So the recommendation before you today is a recommendation to approve effectively a fee pool. That's Council's role, is to approve the fee pool in aggregate. It's obviously up to the CCHL board to then determine how they allocate that fee pool. But in the interest of transparency, we have set out in our paper the proposed allocation of the fee pool as between the chair, the audit committee chair, which is an incremental role over and above the role of an ordinary director, and then the base fee for the balance of the board. The other key point I think to make is that the recommendations before you today have been prepared fully in compliance with Council's policy on the appointment and remuneration of directors. So we have followed that policy very closely. What that policy provides is it provides for a 3-yearly review of director rem. So the review that we completed last year, in fact, which is now the one on the table today, it was predated by a review in 2016. The next review would be 3 years from this point, so we're sort of looking out to 2022-23 before the fees are going to be reviewed again. So this is not an annual review, it's a 3-yearly review. And the increase needs to reflect the fact that it's reviewing the fees for the next 3 years, not for the next 12 months. The other thing about the policy I think that's important to note is that the policy does require recognition of the fact that there's an element of public service involved in the work that the CCHL directors do. And what the policy provides is that means that Council expect under their policy that the remuneration will be set at or below comparable private sector entities. And obviously the recommendation before you today, you'll have read and understood that it's effectively about a 20% discount from the comparable level of remuneration for private sector directors in similar roles. Some other factors, I suppose, just to keep in mind and give a bit of context to the recommendations. All commercial director roles, not just CCHL directors, but in fact all commercial roles over the last 3, 4, 5 years in particular have had a significant increase in the responsibility, the accountability, and unfortunately the potential liability that directors face in taking on governance roles. You'll be aware of some of the increased regulation, some of the regulatory oversight. The FMA's role has stepped up, which is the Financial Markets Authority. You'll be aware of the increase in health and safety regulations, which obviously Council need to comply with and do comply with, I believe. There's also coming down the pipe the TCFD recommendations, which is the Task Force for Climate Change Financial Disclosures. So that's going to step up regulation in terms of climate change disclosures going forward as well. So all of these things are layered on top of governance roles in a traditional sense. The litigation risk for directors has also increased. A number of high-profile examples in terms of director litigation going back to the South Canterbury finance litigation and other finance company litigation activity which was targeting directors. The Pike River litigation, the more recent Mainsdale litigation, the CBL insurance litigation. In all of these cases, directors are being targeted by claimants and their liability is personal. So the risk is personal to directors when they're subject to litigation. In terms of responsibility and accountability, CCHL's balance sheet has changed a lot, particularly over the last 3 years. 3 or 4 years ago, we had about $300 million of debt. We've now got about $1 billion of debt. The vast majority of that was taken on to fund the capital release to Council over the 16, 17, 18, 19 financial years. So I think overall, you know, the director roles that our directors are effectively exposed to and are governing within are increasingly complex, increasingly challenging, and it's increasingly important that we continue to retain and recruit high calibre directors to provide the best governance to CCHL that we can to govern the effectively the $4 billion of assets that sit under the CCHL portfolio. And so look, the final thing I'd say is just to summarise the recommendation itself. The recommendation is to increase the fee pool by just over $82,000. You'll appreciate that roughly, or just under half of that, will be paid to the council of directors, and that's paid to a charity in lieu of the council of directors taking directors' fees under the current policy. So effectively it's just over half of that amount that will be allocated across our independent directors if this recommendation is approved. So I'll stop there and happy to take any questions unless Linda's got anything to add.
Nothing to add, Linda? Okay, thanks. Have we got any questions from anyone? Yanni?
In the report, we're told that organisation council control, the median fee is 37,000 for, that's in the external
So what page are you on, Yanni?
assessments report. Sorry, I've just screenshotted it. It's on page 248.
Yeah, I think I know what you're referring to.
And there's another.
It's in the EQI report, Yanni?
Yeah. So I was just trying to kind of understand. You made reference to the private sector, so as one of the benchmarks, and I'm just trying to understand why we wouldn't use the council organisations benchmark that's been in the report. Yeah,
no, good question. So what EQI have done in referencing the benchmark that Councillor Johansson referred to, but also various other benchmarks, is they've tried to look at a cross-section of benchmarks to reflect the fact that the CCHL role is not directly comparable to any one of the benchmarks per se, but by referencing council-controlled organisation fees, as was referred to, but also referencing governance roles where the entity being governed has a similar asset size, a similar profitability size, a similar size and scale, and a similar set of industry sector focuses, which are some of the other benchmarks that are also referred to in exactly the same table. EQI have referred to a cross-section of relevant benchmarks, and they've effectively taken an average of all of those in arriving at a market benchmark.
But I guess what I'm trying to understand is how is that comparable to a council-controlled organisation?
Well, the issue would be that if you only compared to council-controlled organisations, then you may only be comparing to an organisation, for example, like Civic Building Limited, which is completely different to CCHL, and it's a much better basis to compare CCHL to organisations that have a similar asset base, a similar size of portfolio, a similar spread of risk, and a similar industry sector focus, as compared with comparing to simply a CCO, a generic CCO benchmark.
And you talked about the kind of accountability, but I mean, if you look back at recent times, it's hard to see whether individual directors have taken the accountability for things when they go wrong. So I'm just not quite sure. I'm just trying to understand why that's now factored into getting an increase, when I guess history shows that there hasn't really been any liability individually in terms of the risk. It's always tended to fall back on us as a city.
I'm not sure I follow the question, but I gave you a number of examples where directors have been personally liable and have had litigation against them when things have gone wrong.
Have you got any examples from Christchurch?
Well, it's the potential for it to go wrong, Yanni, is the whole point of it. And
well, we've had plenty of examples of it going wrong.
Yeah, I think what Paul was saying earlier on, though, was it's the exposure to liability that is the issue there, and that's what makes it different from a council-controlled. It's the commercial arm of what we do, and it's that potential exposure. So
I understand that, but over the past 2 decades, where things have gone wrong, I haven't seen any sort of personal liability to those things that have gone wrong. So, I mean, I guess you're saying it's a changing environment, and now going forward there's a much greater chance of that happening?
Could I ask the definition of something going wrong? Because there's...
Well, no, yeah.
Because, I mean, there's something
going
wrong.
Let's do it properly. If you've got to just refine your question to Paul and see if you can make it a wee bit more specific so he understands it.
So just in terms of the risk, I'm really interested in the reward for the risk, right? And I'm interested in trying to understand the argument that somehow being on a council-controlled organisation as a director, you've now got this greater degree of risk, and therefore you should be paid more. When my experience from what I've seen around the years that I've been here is that actually the companies generally end up taking the consequence of when things go wrong. And so I'm just trying to understand why that would be a factor, particularly because they're council controlled, they're not like the private sector where people
But Yanni, I'm sorry to cut you off because we do want questions rather than
so
statements, but the point is there's a market discount applied to this. So you've got the commercial side, we're discounting it to reflect the fact that there is a council element to it. So I'm not sure if you've got more specific question than a statement that would be useful.
I can understand for the private sector why directors would be rewarded for the risk. I'm still struggling to understand. I just wanted to understand a little bit in more detail for council-owned organisations why that should be a factor to justify an increase.
They operate on exactly the same market. So many of our companies, in fact virtually all of our companies, compete with other entities in the same sector that don't have council ownership. So they operate in the same market, they're subject to the same commercial risks, they're subject to the same regulatory risk, the same risk of potential litigation, and the same accountability applies, if not a higher standard of accountability, actually arguably applies to councillor directors or CCO directors, because ultimately the ownership is public. You know, our entities are owned by our community.
Cool. Any other questions? Mike, then Pauline. And can we just check, Aaron Keon, are you on the line? Hopefully.
Yes, I am.
Oh, you are. Cool. All right, Mike.
Thanks, Paul. Just around, I guess, the 20% weighting for the public service. Has that been a historical amount?
Yeah, it's judgment, Mike, but yes, it is. It is the same, very similar discount to what was applied when the directors' fees for CCHL were last set back in, the review was actually in 2015, but the current fees were effective from 1 July 2016. And at that time, it was before my time, but I understand, or I've verified that was the discount that was applied back in 2015-16.
So is that just, therefore, locally? What's happening across a wider area?
I'm not sure what approach other councils take with their CCOs, to be honest, but that is a specific discount that precedent would suggest has been applied to CCHL directors. A similar approach and a similar discount is applied to our subsidiary directors when we set their remuneration. Outside of Christchurch, I don't have data to give you an accurate answer, I'm sorry.
Yeah. And I guess if this was to fail, there wouldn't be another increase potentially until 2022. What could be a potential, outcome of that?
Look, I'd be speculating, and I'd have to go back and have another discussion with our board, particularly our independent directors. But I think it would send a signal that would not send a positive signal to the market that the city wants to ensure strong governance and the best capable governance that it can recruit and retain on our CCHL board and on our subsidiary boards as well.
So do you think it could have the potential to impact the dividends negatively in the future?
No, I don't think it will have any impact on dividends, to be honest. Certainly not in the short to medium term. You know, in the longer term, if the governance is weakened, then it could have adverse implications, but it's unlikely to have an implication in the short to medium term.
You good? Pauline?
Yeah, look, it's probably, just if you can explain to me the table on page 230. So if we just look at the top column for
Sorry, Pauline, can you, if you don't mind, can you direct me to the EQI page number? Do you have that on your screen?
Oh, this is in the in our report. So
yeah, I don't have the same page numbering as you.
5.16. Yep.
Okay, we've got that here now, thank you.
So if you look at the director, just the top line, the directors, and you've got the market rate, EQI recommended rate. So EQI has recommended the market rate less around 20%, is that correct?
Yes, that's right.
And then the CCH board has recommended even less than that.
Yeah, so what we've done, and this is being transparent around how we propose to allocate the fee if it's approved, what we've done is effectively taken some of the recommended increase and allocated a disproportionate amount of it to our audit committee chair, whose role is significantly more time consuming than an ordinary director role, and effectively that's slightly reduced the allocation to the other directors.
Right.
Does that make sense?
Yep, that does. And just following on from Mike's question about if there was a failure to approve an increase today and the next one would not be till 2022, is it a fair assumption that the recommendation then would be around 40%?
Depends how good your crystal ball is.
But I mean, it potentially could be, couldn't it, if you recommend
well,
that every 3 years?
The trend has been that directors' fees have increased over time. So it's likely in 2022, if there's no increase approved today, that there need to be a higher increase in future to recognise that the market fees will have gone up over that period, and obviously there'll still be a discount taken to reflect the public service element. But yes is the short answer to your question.
That's right. So why do we not have a system where we just use an annual incremental set increase along with the market? So that you don't get these what appears to be massive ones because it's a 3-year chunk?
Yeah, it's a good question. I think the rationale would be that if you try and do this exercise every year, you are paying for independent advice every year, and it's probably more cost effective to actually do it on a 3-yearly basis and reset the REM every 3 years and go through that process on a 3-yearly basis rather than on an annual basis, because otherwise you're paying for advice 3 times more than you need to.
Right. So just cost efficiency.
Cost efficiency, yeah.
It just makes it look a lot worse than it is, because in actual fact a 20% increase now actually does not tell the story that there's been no increase for the last 3 years. So it's actually, if you spread that over 3 years, it's not actually 20% per year kind of thing.
Yeah, that's right. And obviously there won't be an increase for the next 3 either. So
Yeah. Thank you.
Any other questions? Oh, Linda, do you want to add something?
Well, I don't want to ask myself a question.
you can ask me one if you want.
Yeah.
All I wanted to say really is from the finance and from the governance and reporting side of the finance team, CCHL's managing $4 billion worth of assets. The quality of governance is fundamental to growing that asset base, the dividends that the council gets from the income streams. And so from our perspective, retaining and attracting high quality, capable directors is important, and already having a 20% discount in place is probably where we would see the line being drawn. That you start to affect that capability. Maybe not right now, but in future.
Okay, excellent. Any other, Pauline? Yep.
Just leads me. Do you, and you may not be able to answer this, but when you use the word retaining high quality directors, and I know that you have got high quality directors on there now, and I'm not trying to grease up to my fellow councillors, would there be a risk if this was not approved today that they may not stay on? Would it be a really negative signal perhaps?
What I'd say is that certainly in relation to our independent directors, there is an opportunity cost for all of them in being on the CCHL board, and that opportunity cost is that they could all be on other boards, but there's a limit to how many board roles they can take on. They all choose and value the opportunity to be on the CCHL board. It's a privilege and it's an honour for them to be in those roles, but they choose to take on those roles, notwithstanding that the remuneration is discounted. And they do it because they want to contribute to the governance of the city and the commercial assets that the city owns. But there is an opportunity cost, as I say, and at some point, if we don't fairly remunerate them in accordance with the policy, they might make alternative choices about what governance roles they take on in future.
Cool. Any other questions? All right, so we've got a recommendation there from staff, and we've just added one to the bottom of it, just to note, obviously, as you'd mentioned, Paul, the additional work and I guess complexity that the Chair of Audit and Risk entails, and that indication that you would have been a $10,000 increase on that basis. So, look, I'm happy to move what's there now. James Daniels, you're happy to second it. Is there any discussion on that? Jake?
Yeah, look, I think in an environment where ratepayers have asked us to tighten our belt and be fiscally constrained, I think that approving this increase today is not, I don't think the optics of that are very good. And I think that obviously, CCHL are yet to implement, although they have made good progress, they're yet to implement a living wage. And I think that this sends a really bad signal to be offering 20% pay increases to those at the top of those companies when we still don't have a living wage for many at the bottom. And addressing the issue of discounting and the process of this, I don't think we need to embark on a process of assessing what the market rate for directors is. I don't think that's truly reflective of the public service element. So again, just to conclude, I would say that we're asking residents to tighten their belt and to put up with a bit of pain in terms of rate increases, and we should be doing that as well with our corporate holdings.
Cool. Yanni, and then yeah, go for it. Yep.
Yeah, I just wanted to echo the comment that Councillor McClellan has made. You know, I would struggle with this increase when we wanted to introduce a living wage to our contractors, and I remind councillors the first person that came to this council asking for a living wage was a cleaner at the airport that we own 75% of, and they still don't have the living wage. And in the same time, we're seeing directors' fees being proposed to be raised and possibly raised earlier as well. So I just don't think it's right that we've got work that we need to do that needs to be funded, and part of the way that we should be considering how that's funded is I actually think people that are well remunerated and well compensated should be sharing that with the people that are at the bottom, and so I can't support this, especially when we see that the council-controlled organisations, the median fee is $37,000 a year, and that's from the Directors' Fees report. I think there's lots of people that will do a really good job for the figure that we're currently paying, and I think you only need to look back at past performance to see that when big things go wrong, actually generally as a city we're the ones that, and our ratepayers are the ones that incur the cost of that. Generally we are the ones that don't get as much dividend. So I think the risk is really inherent on us as a city council and on our citizens as much as it is on these individual directors. And I could give you numerous examples, but I won't go into the details. But I just think we inherently are the ones that are taking on that risk. We need to be prudent with the money that we are spending. And to say that this has no rates impact when actually it could be coming from a dividend that CCHL would otherwise be paying to us to offset the rates, I think is, a way that we need to look at this rather than thinking that it's just cost neutral. Thank you.
Thanks, Yanni. Mike.
Thank you. Look, this is actually not an easy decision to make, and I have thought about this long and hard and read through the report, but I will be supporting the recommendations in front of us. I don't think it's good when we talk about optics to talk about it being it's only a 20% pay increase when actually it's over 6 years, it's 3% per year. And we set a policy, we've set letters of expectations, and this actually is aligned to both the policy and the letter of expectation. You've got to be a little bit careful when you make a principled stand of what the potential outcome of that could be for the council and the city as a whole. CCHL do a very good job, and the directors need to be thanked for that. So I just think we need to be a little bit careful. We need to realise actually the opportunity, I think, to have the real discussion is when we set our policy and letters of expectations, not when they actually follow those and come to us with a recommendation.
Tim, then Pauline.
Yeah, thank you. Look, this is the golden goose, and we really do have to protect it. And one way to do that is rather than kind of do a base rate of pay, we actually need to reward those of excellence that want to serve their community through this process. When we're really looking at this, it's $82,000, half of which, $41,000, goes to charity. So if we're really going to look at this hard, this is the golden goose. If we did not have this at the time of the earthquake, we would have been in a hell of a lot worse position than we are now. So I think we've got to protect it with the best excellence that we can get around that table, and to show our respect to them and to the service that they give the city in the various ways that they do. So I will be supporting this. The fact that it is technically $41,000, that's really what we're talking, because the other 41 is going to charity. Thank you.
Who have we got next? Pauline.
Yeah, thanks. And I agree with Mike. This has been a very, very challenging one, but this questions and answers and debates have been quite helpful for me. Look, this is a multi-billion-dollar company, so that makes it a big difference when you're looking at the type of directors that you need on this. And there's no doubt that we do have quality directors there now, and if this is going to risk losing some of those if they don't get an increase approved, I'd be very concerned about that. And I also appreciate Paul's comments about what the directors do give up in the form of opportunity by accepting a role on the CCHL board. and the fact that they do take a 20% reduction in remuneration. The board's performing very well. They've increased the asset base, it says in the report, by 25%, and they've also increased the annual return via dividends to the City Council by 14%. And as we know, the debt is now sitting at $1 billion, and that is so we could retain our assets in times of crisis. And I think we need to appreciate the work that's gone into that in order for us to retain our assets and receive the capital release. That's significant. So it does concern me that if we don't approve this today, we could actually lose some of those very good directors. It also concerns me that if we don't approve an increase today, they'll be not receiving an increase until 2022, which is a long time, which will be from 2016. So it's too long, I think, to not actually address remuneration. So having weighed it up, after a lot of consideration, I'm going to support this today.
Anne.
Sorry. It is a really difficult decision, and especially having you there, Paul, and knowing how hard you work and seeing the fruits of your labour, so to speak, and the success that you've had. However, I do think that one of our strategic priorities that's underpinning what we do is to ensure that rates are affordable and sustainable, and I think we have to be doing everything we can to reach that goal in the climate that we're in at the moment. And I feel embarrassed in some ways talking like this because I accepted from the remuneration people that I would have a rise, but we had no choice about that. We were told that that was going to happen, and we have pushed back and said we're unhappy with the injustice of the way that they decide how we are paid. But we do have a choice about this. Sadly, we live in a culture where people's value is actually dependent on what they're paid, which, you know, is often not a good way of measuring what people do. I do actually think of our CE, who's sitting here and has made a decision to come to a job where she is being paid a lot less than what she could be paid in other places. And we...
So, Anne, maybe if we focus it on
Yep,
the
sure.
CCHL directors stuff.
Yep, thank you. So we do have a choice about this. And I do hear from the people that hard-working people out at Hallsville who are doing everything they can to make ends meet, struggling with rates. And I don't feel that this would be a very good signal to them that we are actually taking their concerns seriously if we agree to this today. So I will be voting against that for those reasons. I really think that we need to start building a pathway to lowering rates, and this is one small step in the way. So I will be not supporting this today.
Thank you, Jimmy, and then Aaron, if you're there somewhere.
Yeah,
Oh,
so,
and James.
it is very difficult to make decisions regarding to this issue. Yes, I recognize, CCHL, your information, those board chair and the directors, their knowledge, their skills and experience. I also recognize those fee pool is less than the current market rate. But I'm particularly concerned is a moment the external environment has been significant change, because we are all aware, coronavirus, the outbreak now spread over to whole New Zealand and the global. So that's a bigger the impact for our economy, the New Zealand economy and global economy. So, particularly we read the newspaper, we watch the TV, even many.
Jimmy, we're talking about the directors'
yeah,
fees.
yeah, okay, directors, yeah, I know, So, it even impact the lots of the business. So, the moment if we increase the direct fee, but some staff, employee, redundancy, etc., some will shut down their business. So I think this probably regarding the public image, this is reverse the effect. This is my concern. Also, I reviewed the CHL, the information 3.3. Although they will not impact the rates, but still, they will pick up from those the dividend and the CHL. Probably the same pool, they will less to give the to the council, etc. So particularly, just consider and concern this external environment. So I'm not supporting the CCHL the recommendation.
Okay, thanks, Jimmy. Aaron, do you want to say anything?
No, I'm fine.
You're fine. Thank you for that. James Daniels. And then I think that's
Kia ora.
everyone.
Kia ora. People think this role of being a city councillor is easy. Certainly I did. There are people that think the role of being a director of a company under the Companies Act is easy as well. And it's not. Paul very clearly and eloquently explained what the risks are, the role is, the responsibilities. And what I find interesting about this scenario is that here is what I had imagined to be the sole employee of Christchurch City Holdings Ltd, presenting a case for the people that he reports to have their fees brought up to market level, or not even market level. That's the basis that we're starting this number at, and then we're applying a 22% discount on that. We've talked about opportunity costs, so I won't repeat that, but we've got to remember that these people on the board are responsible for over $4 billion worth of our assets, and they are in the commercial space, we're in the community space, where we are the ultimate shareholder of the company, but we need good people in place to run those commercial assets, otherwise the community sinks. So I'm very supportive of the fact that this rise is not that high. We're meeting the market, they live and work in the markets, and we need to make a decision on that basis. So I'm supporting this recommendation.
Thanks, James. Phil.
Thank you very much. Going forward, I look at the likes of Paul and his group. They're going to have their work cut out this year. You've got, out of the 8 companies that are there, 2 are very good, 3 or 4 holding their own. The rest are not too good, and there's probably 1, probably 2 that are in a departure lounge. And we need some people.
We'll just
we need
tighten
some
it up on
people who are
CCHL
strong
today, yeah.
and are getting paid well to make these decisions, because it's not going to be easy for the rest of this year. So I'll be supporting what we do. Holding their rates back is not ideal. We need to be paying them for what they're worth, because they're going to be busy coming up.
Thank you, Phil. Is there anyone else? No, well, I'll just quickly wrap it up. I mean, I think the thing we shouldn't get too trapped on today is the increase. We're approving an increase of the allocation of the pool, and it's up to CCHL how they manage that. I mean, I fully support the idea that we increase the audit and risk chairs thing. I mean, that is a no-brainer in terms of the risk and liability that's there. I think the other thing we as a council need to be really clear on is that CCHL is a commercial buffer. You know, there is a balance between what we do and what they do, and I just really would hate to think that we would disrespect competent independent directors who could be doing a lot more in the market by not approving this today. Now, I think the reality is there already is a 20% market discount. In my view, that actually shouldn't exist. I think it's an entirely commercial organisation, and that they should be doing that, because ultimately, when that doesn't work, we do hold them accountable. And I do accept what you've said, Yanni, but the point I would make is actually it's the council a lot of the time that has caused those challenges. So it's not the directors. They're literally working it out of beholden. So I think, you know, we just need to be really careful about how we manage this. We want to continue to attract competent, intelligent people who will increase that dividend and actually provide the necessary oversight for the holdings company, but the companies that sit within it. So I think, you know, there's been a real debate around rates increases, and I'm absolutely thrilled that so many people who have talked about spending before are really on board in terms of rates increases and rates restraint today. But I think, you know, as Tim pointed out, we're at $40,000 this year. You know, whether you agree with the director's fees policy or not, it's minimal to us. And if we can continue to grow that dividend on the companies that perform well, then we should back the directors to do that. So on that note, I will put it to a vote. All in favour say aye. Aye. Against? Yeah, can we get a division?
Councillor Chan. Councillor Chu. Councillor Coker. Councillor Cotter. Councillor Daniels.
Aye.
Councillor Davidson. Councillor Galloway. Councillor Johansson. Councillor Kewen.
Yes.
Councillor McDonald.
Yes.
Councillor Major. Councillor McLennan. And Councillor Scundrett. 8 for yes and 1, 2, 3, 4, 5 for no.
Great. Thank you. So that motion is carried. Thanks, Paul and Linda, for coming in for that. And I'll give the chair back to Andrew.